Welcome back to the Deep Dive. I hope you had a fantastic Thanksgiving.
Hope it was a good one.
If you're anything like us, you probably just surfaced from that, food coma haze.
Yeah.
Only to find your inbox absolutely overflowing.
It's true. Our stack of Nifty Noon newsletters from, November 24th to December 5th it's huge. The market definitely did not take a holiday.
Not at all. And while we were all focused on, family, football, maybe a third slice of pie, the crypto market just went through this period of profound change.
It really did. We're talking massive institutional shifts, some huge regulatory decisions, and some pretty significant tech leaps forward.
So that's our mission for you today. We're going to cut right through that holiday backlog. This is your definitive deep dive, the shortcut you need to get perfectly caught up on everything critical from our sources.
Yep, no need to read 10 days of news. We've got you covered.
So before we jump in chronologically, what's the TLDR? What were the big themes?
Looking back, there are really four massive themes that jump out from our newsletter. First, prediction markets. They finally became validated institutional players. I'm talking about Polymarket and Kalshi.
Okay, that's a big one.
Huge. Second, the old guard, legacy finance, basically just capitulated. You had Vanguard completely reversing its policy and Grayscale launching new ETFs.
Right.
Third, some really critical Layer 1 developments. Monad's mainnet finally debuted, and Ethereum launched its big Fusaka upgrade.
And the last one?
The last one is this ongoing clash, legacy finance structures versus crypto. We saw it with Tether fighting S&P on its rating, and then Strategy's really high-stakes defense of its Bitcoin holdings.
That is a dense, compelling narrative, and it all seems to point towards this acceleration of mainstream acceptance.
Without a doubt.
All right, so we're going to walk through this chronologically. We'll start with that pre-Thanksgiving hype around Monad and work our way right up to the latest news from Ethereum.
Sounds good. Let's get into it.
Okay, so let's start right before the holiday, November 24th. The Monad debut. This wasn't just, a successful funding round. It was an absolute statement.
A statement is the right word. It wrapped up its token sale on Coinbase and raised a staggering $269 million.
$269.
Yeah.
And the participation numbers were they were wild.
That's what our sources really keyed in on. Over 85,000 participants committed capital. It was actually 1.43 times oversubscribed.
Wow.
Yeah, that signals some really deep public excitement, especially since this EVM-compatible Layer 1 mainnet was launching, immediately that Monday, with promises of listings on all the major exchanges right away.
You just mentioned EVM-compatible. For anyone listening who might need a quick refresher, why is that? Why is that the key ingredient here?
Oh, it's crucial. EVM is the Ethereum virtual machine, right? It's the absolute standard for smart contracts. So by being EVM compatible, Monad basically gets to plug right into this massive, established ecosystem of Ethereum developers, tools, and all the apps that already exist.
So it's like launching a new computer that can already run all the most popular software.
Exactly. It's a huge shortcut. It cuts down years of having to build a developer community from scratch.
Makes perfect sense.
Yeah.
But this is where it gets really interesting when we dig into the tokenomics, which our newsletter flagged pretty heavily. The public hype was there, but the distribution, it raised some immediate red flags for analysts.
It did. The underlying structure really demands a closer look. Our analysis highlighted a very heavy insider allocation. Team members and the early investors hold over 50% of the total token supply.
Over half.
Yeah. And when insiders control that much, it brings up two major concerns. First, the risk of them taking profits short-term is high, which could lead to a lot of volatility.
Right, a big dump on launch day.
Potentially. And second, and maybe more importantly, it gives the team very centralized control over things like governance votes, protocol changes, which kind of runs counter to that whole decentralized idea a lot of investors are looking for.
That is a vital point to remember as this project grows. And speaking of growth, there was a little footnote from that same day. Coinbase acquired at Vector.fun.
Right, an on-chain trading platform built on Solana. So even as they're hosting the launch of this new EVM chain, they're also strengthening their ties to the competition.
A classic case of hedging your bets.
Textbook. Playing for market share no matter who wins the scalability war.
Okay, so we move to November 25th, and the institutional train just keeps rolling. Wall Street officially rolled out the red carpet for two assets that are, let's say they're often highly visible and pretty volatile.
DOGE and XRP.
DOGE and XRP.
This was a huge moment for validation. NYSE Arca approved Grayscale's Dogecoin and XRP ETFs for trading. The ticker symbols were GDOG and GXRP.
And everyone immediately started thinking Chainlink was next.
Of course. The market started anticipating a GLNK ETF to follow pretty soon after.
You know, when you see a firm like Franklin Templeton come out with a statement endorsing XRP, saying it, and I'm quoting here, plays a foundational role in global settlement infrastructure. I mean, that's not a meme coin endorsement. That's a utility endorsement.
It's incredibly powerful signaling, absolutely. But here's the fascinating contradiction we spotted in the market. Despite all this institutional love, the price action for DOGE was, well, it was flat.
So why? Why didn't it move?
Because the supply side was fighting a massive headwind. We're talking roughly 7 billion tokens had been sold off by huge whales in the months leading up to this. So does institutional access matter if the selling pressure from existing holders is just too intense?
And in the short term, the answer was no.
In the short term, it seems so. Massive whale distribution can apparently overpower the excitement from an institutional ETF.
That is such a critical insight for you to take away. Access for new capital doesn't guarantee a price jump if the old capital is heading for the exits. All right, let's pivot now to the regulatory and stability front. This covers November 26th through December 1st. Prediction markets, which have been in this sort of regulatory gray area for years, really seem to have cemented themselves.
They really did. On November 26, Polymarket secured its return to the U.S.
Right. They finally got the green light from the CFTC after being barred back in 2022.
It's a huge signal of regulatory acceptance, but, and this big but, it's only under very specific new rules. Our newsletter detailed the new compliance requirements.
Which are?
U.S. bettors now have to access these markets through registered brokers and what are called futures commission merchants, or FCMs.
FCMs. So break that down for us. What does that actually mean for a user?
So an FCM is basically a traditional financial gatekeeper. Think of a clearinghouse or brokerage. So instead of just connecting your decentralized wallet, you have to go through one of these registered intermediaries who handles all the compliance stuff.
So it's not the decentralized Wild West anymore. It's integration into the traditional system.
That's the perfect way to put it. It brings these markets right under the traditional oversight framework. They're basically indistinguishable from other regulated derivatives now.
And at the same time, we saw Robinhood doubling down on this space, introducing a new futures and derivatives exchange. The brokerages clearly see where this is all going.
The integration is undeniable. The regulation validates the product, and now the traditional players are rushing in to capture that market.
Okay, let's jump to December 1st. A really high-profile clash. The tether tussle with S&P Global. A real battle over what financial stability even means.
Right, so S&P Global, the huge credit rating agency, downgraded USDT's stability rating to weak. They gave it a score of 5 out of 10.
And their main concern was?
It was Tether's increasing allocation to what they see as riskier assets, specifically Bitcoin and gold in its reserves. That plus what S&P called a lack of detailed disclosure. They basically argued this could compromise the one-to-one peg in a major market crash.
So S&P is saying you're holding too much risky stuff and we can't fully see it, so we think you're unstable.
Precisely. They're applying legacy risk metrics to a totally new kind of financial structure. But what's really fascinating is how Tether's CEO, Paolo Ardoino, reacted.
He didn't take it lying down.
Not at all. He publicly said the company wears S&P's loathing with pride and called the traditional rating system broken. He pointed to Tether's massive reported profits and their billions in excess equity, basically arguing that their real-world performance and the market's trust in them is what matters, not some old-school rating.
It's a pretty profound moment. The stablecoin giant is essentially rejecting the authority of traditional finance's main scorekeepers.
It is. It's signaling to the crypto world that they won't bend to old disclosure standards, and it's a structural challenge because, honestly, the market mostly just shrugged off the downgrade.
It highlights a growing split.
A huge financial schism. One system that relies on audits and transparency for trust, and another that relies on performance and massive capital reserves to just enforce its own stability.
And while Tether was fighting S&P, we shouldn't forget, other players in this space were fighting their own battles.
That's vital context. Kalshi's founder was busy defending against a class action lawsuit that popped up on November 27th, alleging they were running an illegal online sports betting operation. So even as one regulator legitimizes the product, lawsuits are trying to define its boundaries. The whole sector is maturing under intense fire.
Okay, so that brings us to the final stretch, December 2nd to the 5th. This whole period was just dominated by institutional validation and some really high-stakes defense.
It really was.
On December 2nd, all eyes were on strategy and its moment of truth. The stock plunged 11% as Bitcoin was tumbling, and it crossed this really critical psychological line.
This was a genuine fear event. For a moment, Strategy's market cap actually dipped below the value of its Bitcoin holdings.
Which, for a company that is basically a proxy for a BTC ETF, is the worst-case scenario.
It is. And to add to the panic, the broader market was seeing these mass liquidations, something like $900 million in just 24 hours, as BTC slid towards 84,000.
And the CEO, Feng Lei, had said before that selling their Bitcoin would be a last resort. So how do they avoid it? How do they hold on?
Our sources highlighted what was, frankly, a brilliant defense strategy. To avoid being forced to sell Bitcoin to cover their bills, Strategy announced a new $1.44 billion USD reserve.
So a separate pot of money.
Exactly. A liquidity buffer explicitly set aside to cover their upcoming dividend and interest payments. By ring-fencing traditional cash for their debts, they protected their main strategic asset. They kept the diamond hands intact.
It's a textbook move in capital management, but tailored for a crypto treasury. It shields the core asset from that short-term panic.
It was a masterclass in holding the line.
And then came the day that really, truly shifted the entire institutional landscape. December 3rd, Vanguard's capitulation.
I would argue this is the biggest story of the week in terms of traditional finance validation. Vanguard, the $11 trillion asset manager, had been the biggest opponent. They famously blocked clients from buying spot Bitcoin ETFs, saying they had no place in a portfolio.
And they completely ended their boycott.
Completely. And they didn't just allow Bitcoin, they opened the floodgates. Vanguard's 50 million clients can now trade crypto ETFs for Bitcoin, Ethereum, XRP, and Solana.
The significance of that is,
yeah,
it's just hard to overstate.
You really can't. The reversal was driven by two things. One, just overwhelming client demand they could no longer ignore. And two, a change in leadership. The new CEO is a former BlackRock exec, the same firm that was key in launching the IBIT ETF. This validates digital assets as fully institution-grade.
It opens the door for potentially trillions in new capital.
That's the potential, yes. And it wasn't just Vanguard. Around the same time, we saw Bank of America start recommending a 1% to 4% crypto allocation for its clients. The consensus is shifting from avoid to allocate.
Institution-grade indeed.
Yeah.
And just when we thought the prediction market story was done, it hit this peak valuation on December 4th. Kalshi closed a $1 billion funding round at an $11 billion valuation.
Right. It's just a stunning meteoric rise, especially with that lawsuit hanging over them. It also made their co-founder, Luana Lopes-Lara, the world's youngest self-made woman billionaire. The capital is clearly not scared off.
And they're expanding beyond just betting on politics or integrating into mainstream media.
That's right. Kalshi secured an exclusive partnership with CNN to display real-time probability data across the entire network.
Wow.
So prediction markets are moving from this niche betting platform to being a source of mainstream journalistic data. And even though right now something like 90% of their volume is sports, that CNN deal shows they're pushing hard into news, finance, and even weather. And for what it's worth, their rival Polymarket is reportedly eyeing a valuation of 12 to 15 billion. The whole sector is just exploding.
Okay, finally, let's wrap the week on December 5th with a huge back-end boost for the reigning champ. Ethereum's Fusaka upgrade.
Fusaka is the 17th major upgrade for Ethereum, and it went live on mainnet. The core feature is something called Peer Data Availability Sampling, or PeerDAS. Now, this sounds super technical, but its impact is actually very practical for you, the user.
Okay, so break it down. What's the ultimate impact of PeerDAS for someone using a Layer 2 app?
PeerDAS is designed to supercharge data capacity by up to 8 times. In practical terms, that means it slashes transaction costs for Layer 2 rollups, which is where most of us are transacting anyway, by allowing nodes to just sample the data efficiently instead of having to download everything. This isn't just a small tweak. It fundamentally lowers the cost for mass adoption of apps and lays the groundwork for that, instant feel user experience everyone wants.
And they're speeding up their whole development schedule now, too.
Yep, targeting major hard forks twice a year now. The urgency is clear. And it all happened on the very same day the CFTC gave its own approval for spot crypto trading on its registered exchanges. The tech is improving just as the legal gates are swinging wide open.
So what does this all mean for you as you're catching up on these last 10 days? The collective narrative seems crystal clear.
It really is.
The institutional gates are opening, whether it's through forced compliance like with the FCMs or through a massive capitulation like Vanguard. At the same time, the market is still incredibly volatile. Look at strategies close call or the whale selling that crushed the DOGE ETF hype.
And crucially, the core blockchain infrastructure, from Ethereum with Fusaka to new players like Monad, is upgrading at lightning speed to get ready for the demand that's coming.
This confluence of events raises a really important question for you to think about. With giants like Vanguard embracing crypto ETFs and regulators like the CFTC allowing spot trading on their exchanges, what fundamentally distinguishes a regulated crypto exchange from a traditional financial exchange in the near future?
The lines are blurring so fast, we might not be able to tell the difference very soon.
A great thought to chew on. Thank you for joining us for this deep dive into the insights from our Nifty Noon newsletters. To stay informed in real time, make sure you're following Nifty Noon on X and subscribed on Substack.
We'll catch you next time.